Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we were looking at the roadmap. Let me go back to that, because here's where we're going to, again, set up this foundational plan, show you how to organize your funds. All right, so again, we have the first part would be if you're 5 to 10,000 in monthly expenses, means 5 to 10,000 in your checking account, and about 30,000 to 60,000 in an emergency fund. And again, the short-term fund is going to be more based on if you're going to spend 30,000 on a car, 40 on a car, 50,000 on a car, whatever that number is, whatever the remodeling things are. We add all that up. Maybe that's 100,000. This might also be some short-term income needs might also go in there, and I'll get into that a little bit more as well. That's all short-term funds, and we have short-term investment strategies for that. Then the long-term, that's where we want to make enough to stay ahead of inflation and taxes. This is so important. You know, if you're making, as an example, if your expenses again are $50,000 a year, okay, you're looking, that means in 5 years you're going to need about $60,000 to buy the same things that $50,000 buys today. Okay, so it's so important to understand it. And the same thing goes if you look at another 5 years, you're going to need about $70,000. All right, 10 years from now to buy what 50,000 buys today. So if that, and 100,000, that would mean in 5 years you need about 120,000. All right, to cover those same things. And if you look at another 5 years, you're looking at about $140,000 to cover in 10 years what 100,000 buys today. So this is so important then that we are investing to stay ahead. Otherwise, our purchasing power goes down. And what does that mean when your purchasing power goes down? What it means is you're going to be pulling more and more money out of your principal to cover those expenses. You're going to be losing money in real world, right? Because you're going to be spending more of your money. And if you're not making enough to keep up, that means your principal starts going down. So we expect inflation at 3 to 5%, inflation and taxes together at 3 to 5%. So therefore, we need to make sure we're investing in such a way to cover that and our distribution rate in addition to that. So when it comes to, because this part of distribution rate is another part. When you're heading into retirement and you're going to start taking money out of your accounts where you've been just putting money in all this time, how you invest needs to be quite a bit different, and you need to have defensive strategies in place. Otherwise, the likelihood of running out of money goes up dramatically. All right, let's take a look at the three worlds. So we've got this structure, right? That's our roadmap. Now, how do we get there? What's that look like? So if we look on the left, you see the first world is that of safety and protection. Things like savings accounts, checking accounts, money markets, right? That's what banks issue out there that are safe and protected, guaranteed basically. Same thing if we look at government issues, we have things like savings bonds and treasuries. 10-year treasuries right now, by the way, are just under, I think, about 2.89% return there. Then you're looking at insurance companies have what are called fixed annuities. If you're not familiar with annuities, I know I talk about them on the show quite a bit, but fixed annuities are much like CDs. They're issued by insurance companies, CDs by banks, of course, but they all have this in common if you look there to the lower left. Principal is guaranteed, interest is guaranteed, penalties for early withdrawal, so you want to make sure that you don't, if you're going to buy a car with the money in 3 years, you of course wouldn't put it in a 5-year CD or a 5-year fixed annuity. You'd want to stick with a 3-year one. Interest rates, typically, the longer the term, the higher the interest rate. So if you go a 1-year CD is not going to pay as much as a 5-year CD. Same thing, a 3-year fixed annuity is not going to pay as much as a 5-year fixed annuity. But the rates on all of these, though, this is the other part of it, are not historically in that 1 to 4 range, are not enough to stay ahead of inflation and taxes, and that's the downside. But this safe world, that might be where, of course, we'd have our checking account, our operating fund, if you will, our emergency fund, and possibly in our short-term fund is going to be in here as well. So those are where we use those typically. There are some exceptions, some other things that we can bring into play as well, but that's your safe world. Now, since it's not enough to, that's where the bulk of our money, in our retirement accounts as an example, we need to find ways, some other strategies that can keep ahead of inflation and taxes. And one of the ways to do that is the stock market. Here's where we can get more potential growth out of our money. Things like individual stocks, bonds, mutual funds, things called exchange traded funds. These are much like a mutual fund. They just trade a little differently. Typically expenses are a little less, but otherwise Vanguard has a mutual fund that's an S&P 500 index mutual fund, and they have an S&P 500 index exchange traded fund. Both hold the same things. There's some ways that these can be used to your advantage. All right, the next is REITs, real estate investment trusts. These you want to avoid. Okay, a REIT is basically like a mutual fund that holds real estate or real estate mortgages. Very illiquid as a result, and so if they get a lot of redemptions, or if they get into other problems with their real estate portfolio, they typically don't have enough money, and you could find yourself, and many of you may have experienced this, where you've invested in a REIT and they go into default and you can't get your money back out. I mean, anything else that you look at, for the most part, if I own a stock and it starts going down, I can sell it and get my money back. If I own a mutual fund, same thing. Exchange traded fund, same thing. Bonds, same thing. But what happens here is my money could get locked up and I couldn't get it back out, and it's just stuck. And I may lose all my money in something like that. Now that can happen anything. A company can go out of business. A bond can default. So there are risks, and that's why we want to make sure you need to understand how these things work, how to use asset allocation models to protect yourself. So a portfolio that's got thousands of unique holdings, different companies, when we're talking about individual stocks and bonds making this up, this is a way to protect yourself, as an example, that kind of diversification. Then some companies may get into trouble, but you've got enough that it's a small blip, and the others are making enough to make up for that, and I'll show you how that works. Next is variable annuities, that big red X. About 80% of the annuities in the marketplace are variable annuities, and these you definitely want to avoid. And the reason is I'm taking all that risk of the market, right? Look there at the lower right. Principal's not guaranteed here, is it? No guarantees at all. We don't have any interest guarantee. And the other part, we need to be looking at long-term investors if we're in the market. And what we look at there is rolling 10-year averages. So you need time, all right, to take advantage. So a long-term investor, and by that, first off, thinking in terms of you're investing for life, right? This is, how long are you going to need money? How long is your money going to need to make money? For the rest of your life. So therefore you're a lifelong investor. So our plan typically is one that we stick with for that same time, for life. We may tweak it, things may happen, life may happen in such a way that we need to make some changes, but those usually aren't big things. And we have defensive strategies to protect us against problems with regard to downturns in the market and that kind of thing. So that's well, going back, let me go back. This is where historically, by the way, we do earn enough to stay ahead of inflation and taxes, and that's the key. But by the same token, what that return is going to be depends on your asset allocation. That is the biggest determinant of return on your portfolio, not individual stock picking, not market timing. It has to do with your asset allocation model, and we're going to talk more about that. All right, and in the third world is banks have what are called index CDs, insurance companies what are called index annuities. This is where you have all the guarantees of that first world, where your principal is protected, right? And then you're linked to the market through an index like the S&P 500 index, the Dow Jones Industrial Average, Bloomberg Aggregate Bond Index, and then there are other indices that I've talked about, like the Mosaic, through Nationwide and JP Morgan, the Schiller Cape Index through a company called Athene. These are indexes that can help you control volatility and again get a better returns. The key is they need to be uncapped indices. We're going to take a break. When we come back, I'm going to explain what that means to you and why it's so important, because without the right, any investment, if you're talking about stocks, people have lost tons of money in the stock market, right? Companies that have gone bankrupt, companies that have gone out of business, stuff like that can happen. So if you're not invested and diversified and using these strategies that I talk about, then you're at much greater risk there. Same thing goes annuities. There are variable annuities, you want to avoid them. That's 80% of them. So we've just eliminated like 800 different products out there. Then you got fixed annuities that might have a niche, and then you've got the index ones, and here you need uncapped, and many of them, most of them in fact, are not uncapped. They have caps, and that means you're again limiting your returns and your results and and that's going to impact your long-term plan. But if done properly with uncapped indices, and we've narrowed down to about 25, maybe 30 products that would fit for this, okay, out of 1,000, all right, that's the way. So, but this is the same thing. It's using the proper strategies, using the proper products to attain these goals. All right, we're going to get back into this construction, and we're going to talk some more about the markets, and we're going to and how to utilize some of this in your own planning. And how to protect yourself, so when you're retiring, you're not going to have to worry about running out of money. This is so important. And guess what? No do-overs. We got to get it right the first time. All right? But we're going to do that. So join me here. We'll be right back on the Retirement Report.